Hi, good evening everyone. Welcome to Phillip Futures webinar. Today's our webinar topic is understanding and trading the US yield curve. I'm your host tonight and my name is Regina. Before we start, I would like to do a sound check. If you all can hear me, please click yes in the poll so that I will know that my mic is okay and everyone can hear me. Okay. Okay, so great. Everyone can hear my voice. Today we will have an interesting sharing by Mr. Tarek Denison, and we will giving away 25 ringgit Shopee voucher to 5 lucky winners. So please listen carefully and stay until the end of the webinar so you can stand a chance to win it. And if you have any questions during the webinar, you can type in the chat box. We will answer it at the Q&A section. As usual, I will start from the disclaimer. I would like to emphasize that everything we share tonight is for education purpose only, and it does not constitute any recommendation to buy or sell any investment products. So if you want to invest, you shall seek advice from a qualified financial advisor. I will leave our representative contact number at the end of the webinar. Okay, in case some of the audience didn't know us, I would like to do a little introduction of our company. Our company is Phillip Futures, and we are a wholly owned subsidiary of Phillip Capital, and we are incorporated in the year 1995. So, Phillip Capital is our mother company from Singapore. But for Phillip Futures Sdn Bhd, our headquarters is located in Kuala Lumpur, and we have branches across Malaysia, such as Kota Damansara, Johor Bahru, Penang, Malacca, and for East Malaysia, we have branches in Kuching, Cebu, and KK. Phillip Futures is a trading and also a clearing participant of Bursa Malaysia derivatives. We are also a holder of the capital market license, service license, which qualified us as a legal and regulated broker in Malaysia. And last year, we are very proud to win these 3 awards from Bursa Malaysia as the first runner-up for the Best Overall, Best Retail, and Best Institutional Derivatives Trading Participant. And we would like to thank our clients and also appreciate them for their trust and support in us. And because of that, we are able to win these recognitions. And this, our mother company, Phillip Capital, we have wide network around the globe. You can see from the map here, we have offices in over 14 different countries as pointed out. And as for futures, we also provide products listed in other exchanges from US, Europe, Japan, Hong Kong, Singapore, and so on. So with our global coverage, clients can trade both the local and foreign products in one platform that we offer. In Phillip Futures, we offer 2 main products. One is futures and the other one is CFD. For futures, we have few categories of products such as interest rate, index, energy, agricultural, and metal futures. Tonight, we will be focused on the interest rate and index futures. For those who also trade the stock market, we also have contract for difference, also known as CFD. We offer Bursa and US share CFD as well as the US indices share CFD. And next, why trade with us? First, we offer 24 hours broking and execution support for our clients. So you can call in our dealing desk if you need any help regarding trades or your accounts. We also send out our latest market news and commentaries exclusively to our clients on a daily basis through email. And we also provide a wide array of products that allows clients to trade both local and foreign products. And lastly, we also provide advisory service on what kind of products you want to trade or how you can get started on trading. Other than that, we also provide free one-to-one coaching section, free seminar or webinars, and also free account opening. So during the free one-to-one coaching sections, we are targeted for the beginners. So our cover topics like introduction to futures, trading, product knowledge, platform coaching, and also tracking system. If you need this kind of coaching section, you can approach our representative to arrange. And next, I would like to introduce our platform. It's called Phillip Nova. We have web-based and also phone apps version. We have over 90 technical indicators. If you want to use our demo account, you can scan this QR code to try out our platform. So this is our current ongoing promotion, which is trade CME micros futures at USD 2.5. So you can trade the micro futures with the smaller contract for the US indices, silver, and Treasury used in USD 2.5 commission rate. So without any further ado, I would like to invite our speaker tonight, Mr. Tarek Denison. He is a multinational wealth manager with a passion for financial education. So today he will sharing our very interesting topic. So I would like to pass my time and control to Mr. Tarek. Okay, Mr. Tarek, you're up.
Just making sure I hit the right unmute button. Regina, can you hear me?
Yes, I can hear you loud and clear.
Excellent. Well, good evening, everyone, and thank you very much for making it to this presentation. I know Regina promised you an exciting presentation, and it's not very often that I think you hear exciting and US interest rates in the same title, but I do promise I will try my best to get you excited about the US yield curve, and especially how you can add trading strategies on the US yield curve using these new micro futures contracts to your trading strategy. Now, I know Regina wanted to make sure that you could hear her with a poll. I'm going to ask you to go to the panel all the way on the right again to the tab called questions and just quickly type in a Y, a hi, a hey there. That will tell me, first of all, that you can still hear me, but also make sure that you know where to answer questions. Okay, great. Any questions that you have during this presentation, please go ahead and enter them there. At the end of my presentation, Regina will pick the questions to ask me, and we will be answering all of the questions at the end. So with that, let's go ahead and get right into it. Those of you who've attended any of my presentations before, you know that I usually like to put something on the title slide which will provide some perspective or some interest in what I'm going to be talking about. And here, given that we're going to be talking about US Treasury yields, I thought there was nothing better than to put an actual US Treasury bond on my slide here. If you have time, you could of course go ahead and read the fine print. I'm going to show you a picture of another bond later, just as a bit of background for any of you who may not be fully familiar with what exactly a bond is. And when we say the US 10-year went from 2.1 to 2.2%, what exactly does that mean? I'm going to try my best to give you the most concise crash course on this in the next few minutes. Before I begin, here is my disclaimer as well. And a little bit more about me, in case you haven't heard my voice before. My name is Tarek Denison. I am a trust and estate practitioner. I am licensed to manage money and provide investment advice in Hong Kong and the United States. But interesting fact on top of that, I just moved to Switzerland late last year, and so I'm in the process for applying for licenses to be able to do that in this time zone as well. I've been in the markets for a fairly long time, not quite 25 years yet, but only since about 1998. I started with Commerzbank, a German bank in their New York offices, but also worked in London and Frankfurt for a while. I then had a good stretch of my career at Bear Stearns in New York before it was taken over by JP Morgan. Then I worked for the Canadian bank CIBC, which was the firm I came to Hong Kong with. And then I spent 1 year with the French bank Société Générale. I have a master's in financial engineering from the University of California at Berkeley, go Bears, and I teach two Masters in Finance courses at ESSEC Business School in Singapore, which gives me a good excuse to come to Singapore every spring. One of those courses is fixed income. That is where I teach aspiring bond traders everything that they need to know about yield curve modeling and how to manage a portfolio of bonds. My focus for a long time really has been on the US-Asia corridor, although I'm going to have to spend more time on Europe given my new focus here in Switzerland. And if you want to read more about what I've written, my first book is titled Invest Outside the Box, Understanding Different Asset Classes and Strategies. I'm in the process of writing my second book if you want to look me up that way. So that's enough about me. What are we here to talk about today? We're here to talk about US interest rates, the US yield curve, and most importantly, how can you make money by trading it? So on the yield curve, I'm going to give you a background on what US Treasuries are. So 101 on US Treasuries, bond math, US Treasury yields, what is the yield curve, and so forth like that. I'm going to give you a brief history of the yield curve and why, for example, you will hear differences between what's happening in 2-year yields versus 10-year yields versus 30-year yields. And that's, of course, going to be very, very important when you try to come up with your strategy of, do I want to put on a position that makes money if the 10-year yield goes up relative to the 2-year yield? And I'll show you an example of that specific strategy later on. I'm also going to explain why yields matter. Some of you may have come here already saying, okay, I know I'm interested in US interest rates and I want to know how to trade it, but some of you may be equity traders, or you may have more of a background in commodities, and you may say, does it make sense for me to add interest rates to my trading portfolio? Why does it matter to other things? I'm going to explain the economics of what happens when interest rates are higher. What does that mean for stock prices? What does that mean for oil prices? And what would that mean for you using yield futures as a hedging tool? I like to provide lots and lots of historical data. And usually when I look at the history of anything, I try to go back a long way so that we can see, for example, what happened to the US yield curve in the 1970s when there was very, very high inflation. What happened in the 1990s when internet stocks also did really, really well. What happened in the 1940s when there was a world war. All of those give us real historical cases to kind of shock test any given idea that we might have on what will happen to the yield curve, and so what might happen to our interest rate strategy if, let's say, the war in Ukraine takes a different turn or the Federal Reserve makes a different decision. We want to know how those things are going to impact our strategy. So that's what I'm going to summarize in the part of my presentation, which is what makes different parts of the yield curve go up and down. What makes the two-year yield go up and down differently than what makes the 30-year yield go up and down. Now, in terms of trading strategies, I'm first going to introduce the micro yield futures. To any of you who are already familiar with, say, trading bond ETFs or bond futures or Eurodollar futures, these are different. These are not quite the same thing of anything you might be familiar with before, but CME launched them with the goal that they are both smaller and easier for individual investors to trade, but also much, much simpler. So I'm going to try to explain these with a few examples to hopefully make clear how these work, but I'm not going to be talking about bond futures. I just want to let you know, if you're used to trading bond futures, these are very, very different. I'm going to explain how they work from a futures trading point of view, meaning if you put on a position and then the yield moves in a certain direction, how is money credited to your account or taken out of your account, and how would you put them together, say, in a spread trade? More importantly, I'm going to show you what this will actually look like when you log into your Phillip Futures account and actually want to enter a trade. I'm doing this on a desktop, but obviously, as Regina mentioned, you can try this on your phone as well. Within that Phillip screen, I'm going to show you a sample trade, both of a directional trade, where I'm just going to, let's say, buy the micro 10-year yield future with the position that the yield is going to go up or down. And then I'm also going to show you a spread trade, showing you the example of I believe the 2-year yield and the 10-year yield are going to, say, move in opposite directions, or they're going to converge, or they're going to diverge. How do you put that specific trade on? So going all the way back to the beginning, to any of you who may need a refresher on what bonds are, what US Treasuries are, what does it mean when we talk about the 10-year being 3% or whatever that number might be, This is a picture of a bond. This, once upon a time, is something that you might have bought from maybe from your bank or your broker. And the reason that they're called coupon bonds is that you actually would have clipped the coupons down at the bottom and then taken them to your bank every 6 months to get the interest payments. This is something that, let's say, my grandmother would have bought with her savings, and she would have clipped the coupon on the bottom every 6 months, taken it to her bank, and that would have been part of her retirement income, just spending the interest on one of these bonds. Many bonds nowadays are traded entirely in electronic form. So if you hold a bond in your account, the interest would just show up. But this is the physical representation of what a coupon is and what a bond looked like back in the day. What does it mean when we talk about the yield of a bond, though? When we looked at this earlier bond, we saw this was $1,000, and every 6 months you would have received $12.50 of interest. Well, that's a fixed income security. That's very simple. What's so hard about that? Well, the difference is that the price of this bond will not always trade at $1,000. Sometimes it'll trade for $950. Sometimes it'll trade for $1,100. And that's going to mean that the actual yield, the actual rate of return you earn on this bond will be different. So crash course into bond yield math. If you have a 10-year note with a 3% coupon, so that is, let's say, $1,000 note that pays $30 a year in interest, if it is trading at 100% of fair value, so if a $1,000 note is trading at $1,000, the yield would be simply 3%. It would be the same as the coupon rate. But once a 10-year note is issued, that thing trades in the market the same way that any stock or any cryptocurrency or any commodity might. And if that bond rises in price to 105, so let's say a $1,000 bond is now trading for a price of $1,050. We say that's a price of 105. It's still paying 3% of the $1,000, and you're still only going to get $1,000 at the end of 10 years. But the rate of return on that, because you have to pay a higher price, is 2.4%. The exact opposite happens if the price were to fall to 95, meaning if you can buy a $1,000 bond for 950, and then it still pays 3% on the full 1,000, the yield on that bond is 3.6%. These are just two examples of what the yield is at two different prices. But the general rule is that when yields go up, bond prices go down. When yields go down, bond prices go up. When bond traders trade bonds, they are trading prices, they are not trading yields. When we are talking about the micro yield futures, you are going to be trading yields directly. So if you have a view that the 10-year yield is going to go from 3% to 2.8%, you would take a different position in bond futures than you would in micro yield. And I'll show you the examples here. So this is the terminology I want to make sure you're clear on to make sure you're thinking in yield terms versus in price terms. Now, I've talked about the 10-year at 3% or 2% or different rates. What has the 10-year yield been throughout history? This is the longest series I was able to get, going all the way back to 1871. I haven't updated this since 2020. I probably should be updating it because now it would be 151 years of data. The US interest rates really didn't move that much before about the 1970s. There's a number of reasons for that, just simply being how bond markets operated, how the Federal Reserve worked. But in the late 1970s was the last time that we saw such high rates of inflation like we've only started to see now. And as a general rule, when you talk about why should you care about interest rates, well, interest rates will usually track inflation. If I put $100 away in a bond, I'm usually not going to want to earn a rate of return much below the rate of inflation. So in the late 1970s, when inflation was very, very high, interest rates started rising, and the Federal Reserve eventually raised rates until inflation stopped. And then you saw the most significant fall in interest rates really in the modern world since the beginning of the Industrial Revolution. Now, for the past 10 years, interest rates have been very, very low. And the difference of opinion are between those who think interest rates eventually have to rise versus those that think that interest rates are going to stay low for a really, really long time, and they're going to keep trading in a range. That depends on your opinion on economics. That depends on what you think the Federal Reserve is going to do. That depends on what you think the inflation is going to do, what the dollar is going to do. I'm going to talk about those drivers later, but this is your background on how interest rates have moved during two world wars, the Great Depression, inflation in the 70s, an economic boom in the 80s and 90s, throughout the 2000s, throughout the past 10 years, and so forth. Now, in terms of the yield curve itself, what is the yield curve? Where do we see it? What does it look like? There are many, many different ways of looking at it. This one simply shows you the yields of all of the different US Treasuries currently outstanding by their weight in an index. So what I did was I took all the different US Treasuries maturing anywhere from 6 months from now to 30 years from now, and I plotted their yields on a chart. Now, if you were to draw a curve through this, you'd see that it's not a straight line. It's not even a nice simple curve. It's very, very steep out to about 3 years. So very, very short dated bonds yield a little over 2%, and then they go up to yielding about 2.7% at around 3 years. Then it's relatively flat going out to about 15 years. Then there's a bump out to about 20 years, and then 30-year yields are actually a little bit lower than 20-year yields. So the yield curve is not always super, super smooth, but in generally we talk about a normal yield curve when short-term yields are lower than long-term yields. Long-term yields are higher than short-term yields. And we talk about the curve being flat when all the yields are the same, and inverted when short-term yields are higher than long-term yields. Each one of those different yield curves, in a sense, tell us something, because anyone who buys a 10-year note at a 2.8% interest rate, in a way, is saying, I am happy with a 2.8% rate of return for 10 straight fixed for 10 straight years. That it built into that is expectations about inflation, expectations about rates of return on other assets, expectations on all sorts of other things that someone is willing to lock in for 10 years. And then you think of what is the difference between doing that for 10 years versus doing that for 30 years? How much more do I need to get paid in terms of annual return in order to lock in my rate for 30 years instead of 10? Those are all of the opinions of all the different participants in the market that are really summarized in this one chart when you pull out the yield curve. So why do yields matter so much? Even if you're not a bond trader, even if bonds are not a big part of your portfolio, why should you pay attention to the yield curve and be interested in what the 10-year yield is? Well, the Treasury yield, first of all, shows you what the fixed rate of return you can get, what you can be guaranteed over any given time horizon with, quote, no risk. So earlier I said, for example, if the 2-year yield is 2.8%, the 10-year yield is 2.8%, and you're trying to decide between buying a bond or buying another investment, say a cryptocurrency or a stock or some commodities or a piece of real estate or a property, would you want to buy that other investment that has risk if it's going to return less than 2.8% per year? Well, no. If 10-year yields were only 1%, then your threshold is lower. If 10-year yields are much, much higher, if 10-year yields, say, go to 5%, that really raises the hurdle. That really raises the rate of return you need to earn on any other investment to make a risky investment look more attractive than a relatively risk-free investment with that fixed rate of return for 10 years. So the starting point is that you really have to look at it as your hurdle or your benchmark for any other investment that you might make for any given time horizon. That's from the investor's point of view. From the borrower's point of view, the yield curve also matters because let's say, for example, you are running a company. Let's say you are running Keppel in Singapore, or you're running Evergrande in China, or you're running Starbucks in the US, or whatever your business might be. You at any given time might want to borrow money to, say, go set up new stores, go build a new property, go do any number of things. And what interest rate you pay to borrow money for 10 years will decide whether or not certain investments, certain projects make sense. Starbucks may decide it's worthwhile to borrow money at 10 years at 4% to go build new stores. But if that yield goes up to 6%, it may no longer make sense for them to borrow. So in short, lower rates encourage borrowers to borrow, and they discourage savers from saving money in fixed rate instruments And they instead tell savers, go take risk, go buy stocks, go buy properties, go buy other things. That's why when yields have been going up this year, many other assets have been falling in price because the hurdle rate at which those investments make sense has become a lot higher as well. So you can think of higher yields as a way of weeding out enterprises with lower rates of return on capital. That's one way of thinking about it. If we zoom in on the US yield curve, the earlier chart I gave you was just the 10-year yield, and it went back 150 years. This one only goes back to the early 1960s, but it shows you how the yield curve has varied. And it also shows you that before about 1980, there really wasn't a lot of difference between the 2-year yield and the 10-year yield and the 30-year yield. The yield curve generally moved up and down together. But since the 1980s, and especially since the 1990s, you see a pattern, almost a cycle really, where when the Federal Reserve cuts interest rates because of recessions, and recessions start in these gray bars, the Federal Reserve cuts interest rates because they want to lower borrowing costs. They want to discourage people from just keeping their money in savings. They want people to make riskier investments. They want to stimulate the economy. That 2-year interest rates comes down a lot more quickly than longer term interest rates, because anyone buying a 10-year or 30-year thinks, yeah, you know what? The Fed's going to cut interest rates for a while, but eventually the economy is going to recover and rates are going to come back up. So I'm not going to accept a much lower rate of interest on my 30-year bonds just yet. And you've seen this pattern over and over again in the early 1990s, in the early 2000s, in the 2008 to 2010 crash and recession. And it was really only over about the past 10 years, so from about 2010 to 2016, that you saw the yield curve as steep as it has been. When the Fed hiked rates in the late 2010s, you saw the yield curve starting to flatten, almost indicating a recession. But the last recession was actually triggered by COVID, was actually triggered by the pandemic. And that's what brings us to where we are right now. You look at the very end, you see that we went from a period where the curve was steep now to where the curve is flattening again. So all of those are things to keep in mind when you want to decide whether to trade the 2-year or the 10-year or the 2-year versus the 10-year and so on and so forth. This chart gives you a little bit of that perspective, and I've provided a link to the St. Louis Fed for you to pull up this chart yourself. For those of you who like prettier pictures and prettier graphics, this one was run by the New York Times, and they don't update it that often, but every now and then you can see an updated version of this. This one shows you a 3D picture of how the yield curve has moved over time, but only really going back to about 1990. So you can see in 1990, the yield curve was relatively flat. Then you saw short-term yields came down more than long-term yields. Then you saw they came back up. Then you saw they came back down again in the early 2000s. Pretty much the same sort of thing I thought I showed you in the last chart, except this one does it in 3D. Again, I provided the link to you if you want to see how the New York Times has updated that since then. So those charts were all a little bit longer dated. If we want to zoom in really on just the past 5 years, because most of you trading this, I'm assuming, don't have 150-year trading time horizons. You want to look at, let's say, what position do you want to put in the September futures contract, and then you're going to have to unwind and roll it in September when you go into December. Where are we in the cycle right now, and how do you come up with the decision of whether you should, let's say, buy the 2-year, sell the 10-year, sell the 10-year, buy the 2-year, or so forth? This is a chart, again, from the St. Louis Fed, which zooms in on a much closer time period. How you analyze this chart, how you come up to your conclusion of what the Fed is going to do next, what's going to happen next to inflation and so forth, is up to you, but here's another place you can get that data. Earlier, I've mentioned a very popular spread that many traders follow, which is called the 2s 10s. 2s 10s simply means the difference between the 10-year yield minus the 2-year yield at any given point in time. It's a very easy number to calculate, and in fact, with the futures, these micro yield futures, you can trade that just simply by buying one future and selling the other. One pattern you may notice is that any time the yield curve has inverted, really since this has been watched since the 1970s, a recession has immediately followed. So for example, you look at 1980, and in 1982, the yield curve had inverted, and right after those, there was a pretty deep recession. In the early 1990s, the yield curve inverted, the 2-year yield went above the 10-year yield, there was a recession. The same thing in 2000, 2001, although that was triggered by 9/11. The same thing in the late 2000s. There you can actually say the short-term yields did trigger it because they triggered many mortgage defaults. And then again, you saw in the late 2010s, early 2020, the yield curve very briefly flattened, very, very briefly inverted. Now, again, that probably didn't predict the pandemic, but this is how you see it on the 2s, 10s. So this particular spread is probably the most watched one by interest rate traders. So that's the history. What about the drivers? I've briefly mentioned inflation. I've briefly mentioned economic growth expectations and so forth. If I were to summarize what makes yields go up and down, I've tried my best to put it in this slide. So this slide on the left tells you what drives short-term yields, what drives 2-year yields, and on the right shows you what drives longer-term yields, especially the 10-year and the 30-year yields. So if you're going to be trading the 2-year, you're really focused on the Fed. The 2-year yield is basically an expectation of what is the US Federal Reserve going to be doing in the next 2 years. If the market is expecting more Fed rate hikes, then you expect 2-year yields to rise. If they're expecting the Fed to slow down hikes or possibly even cut, you're going to see 2-year yields fall. And so then that begs the question, when does the Fed hike rates? The Fed hikes interest rates. The Fed raises interest rates generally because of one or two things. Either they are worried about inflation and they want higher interest rates to cut off inflation, but they will also only hike rates when employment is robust. Remember, the US Federal Reserve has a dual mandate. The mandate is to keep inflation under control, to keep prices stable, and to keep the economy at full employment. So if there's inflation, but then there's very, very high unemployment in the US economy, the Fed is less likely to hike. That is why bond traders pay so much attention to employment numbers. Specifically, they pay attention to a number called the non-farm payrolls number. When employment is weak, in other words, when there's high unemployment, when a lot of Americans don't have jobs, one of their mandates is that they should cut interest rates in order to encourage businesses to go out, borrow money, expand, hire people, give those people jobs so that the unemployment rate comes down. That, in a nutshell, is how it works. When I say Powell isn't Volcker, in other words, the current Fed chair is not the same as the Fed chair in the late 1970s, early 1980s, who really wanted to hike interest rates aggressively to choke off inflation because he said you can't deal with employment until you've dealt with inflation. That is not what we've seen from Powell so far, although this story hasn't been fully written yet. I mean, we're still talking about high rates of inflation in the US. The Fed is still in the hiking cycle. We still don't know how far that they're going to go. And if you've got a view on the Fed, you can trade that with the 2-year futures. Now, on the right-hand side, that's on the long end of the curve. What drives 10-year and 30-year yields? Well, short term, it's not really the Fed. Really what it is you have to look at an expectation of what long-term nominal economic growth is going to be. And I probably should have highlighted the word nominal. Not when you hear GDP growth, you say the economy grew at 2.5%. Usually that's talking about real growth. So that's talking about the actual rate of economic growth plus the rate of inflation. Usually you would expect interest rates to capture nominal growth because they need to pay you for inflation, plus they need to pay you compensation for keeping your money away when the rest of the economy is growing. Real yields have actually been negative for many, many years, so that's one thing to watch out for again there, but that is a benchmark that many pensions and many other long-term bond investors look at. They say, do I want to take 2.5% fixed, or do I want to invest in a risky asset that's going to give me a higher rate of return? Another big factor which you really need to watch long-term is demographics. Older populations mean that there's more money in those pensions. Those pensions need to go somewhere. A lot of them will go into long-term bonds, whether they those prices make sense or not. So there's more buyers of long-dated bonds and less borrowers, less young people going out and taking mortgages, starting businesses, building factories. So there's less demand to borrow for 30 years. More people want to lend for 30 years. What's that going to do? That's going to push down long-term bond yields. That's going to slow down economic growth. And that's also going to keep inflation low. So that's why my own view is that the current rate of inflation, when people talk about 8%, that's a spike for a few quarters, but the market expectation right now is about 2.5% inflation for the next 10 years. And I don't think it's going to be really that much higher than that. The big example to watch there really is Japan. And I've spent a lot of the past 20 years studying the Japanese economy and really trying to watch out for which economy is going to do what Japan has done over the past 30 years. Those of you who've studied Japan have a pretty good idea of what I'm talking about. So when we talk about the Fed, a lot of what you may hear is, oh, the Fed is printing so much money, that's going to, drive so much inflation. Um, what's that ultimately going to do to interest rates? That's why interest rates have to rise. That's why the dollar has to collapse. The chart that I put here is meant to really give a bit of a picture on the Fed's activity in perspective. So this chart is what's called M1, which is the narrowest measure of money supply. So that is a measure of pretty much all of the bank deposits that can be taken out at very, very short notice. And you'll notice that from 1960 to 1970, the money supply grew at a pretty healthy rate given the rate of the US economic growth. Now, there was a huge spike after COVID. That monetary stimulus that we saw was really, really unprecedented, how much the Fed came in and bought bonds and stimulated the economy and so on. But I like to draw this red line to show that if the Fed had continued growing its balance sheet at the same rate that it did from 1960 to 1970, it would pretty much be where it is now. Effectively, what COVID did was it forced the Fed to pick up the pace of its balance sheet growth to what it should have been if the 1960s never stopped, if you think of it that way. This is not, I would say, a consensus view. It's not what every economist thinks, but this is one chart that I use to put the Fed's money printing in perspective. Now, in terms of inflation, this is when you hear that inflation has hit 40-year highs, the highest rate in 40 years. This is one way of looking at it. And again, I provide you a link to where to look at this data on the St. Louis Fed's website. This one shows you the year-on-year change in inflation, the year-on-year change in the Consumer Prices Index in the United States going all the way back to the late 1940s. And you can see, yes, it was high after World War II. Yes, it was high in the 1970s. And then really for the past 40 years, it's been flat until this year. So this spike where you're seeing 7.5% year-on-year inflation, this is the chart where you can see it. Now, in terms of bond yields, earlier I mentioned nominal economic growth, and the yields that you're going to be trading are nominal bond yields. But many investors like to look at what are real bond yields. If I take that 2.8% 10-year yield and I subtract out the rate of inflation, what do I get? In order to find out not what just the current one-year rate of inflation is, but what is the market expectation for inflation, you look at something called Treasury inflation protected securities. So these are bonds that are indexed to inflation, and the yield that they pay you is actually a real rate of return over inflation. We are not talking about futures contracts on these. I don't know of any futures contracts on these tips, but there is a market for these. These are bonds that exist. And so you could actually trade the real rate of inflation in the US if you want to, and see how much of that 2.8% yield is inflation and how much of it is a real rate of return on top of that. The reason that I pulled up this chart is that the rise in yields this year, surprising to me, were actually not at all to do with a rise in inflation expectations. They were entirely due to a higher demanded rate of return on bonds. So in other words, the market still thinks long-term inflation is going to be about 2.5%, just like they did 6 months ago. But now bondholders are demanding a higher rate of return to hold longer dated bonds. That's what happened. Now, earlier I mentioned demographics. This is my favorite chart to illustrate it. This chart plots several different countries, and it shows you the median age of that country relative to its government bond yield, relative to its interest rates. Now, this is a little bit old. This is 2015, but the pattern is still pretty much the same. You'll notice all the way on the lower left-hand, or sorry, lower right-hand corner of the chart, depending which way you're looking at this, you'll see Germany, Italy, Japan, Switzerland. These are countries with very, very old populations and very, very low interest rates. On the other extreme, on the upper left-hand side of the chart, you see India, Indonesia, Mexico. These are countries with high interest rates, but also very young populations. More than half of Indonesians are under the age of 30, for example. More than half of Indians are under the age of 30. That is not unrelated to their higher rates of interest. Why is that? you don't have as many old people with pensions buying long-dated bonds, but you have lots of young people going out taking car loans, going to borrow to buy flats, more expansion for people who need to go build factories to give all those young people jobs. You don't see that in Japan or Switzerland or Germany anymore. And that's why these are very, very important factors to look at when you look at what drives long-dated bond yields. So that's all the background, which will hopefully give you an idea of how to have a view, how to formulate your strategy of which parts of the yield curve are going to go up and down. Now let's talk about how to actually trade it. So first of all, before you even log into your Phillip Futures account, I highly recommend you go directly to the CME website, and I've provided a link below, because this will let you read more about each of the futures contracts you will actually be trading. It will provide you information on what the size of each contract is, when the contracts expire. It'll show you their latest traded price and so forth like that, and it's all there on their website. The 4 contracts we're going to be talking about today are what are called the micro yield futures, and they are available for the 2-year, the 5-year, the 10-year, and the 30-year. All the way on the right side of this chart, your left, depending on how you look at it, all the way on the right side, you'll see the volume and the open interest. So probably not too surprisingly, the 10-year and the 30-year are the most traded of these contracts, but the 2-year is fairly widely traded as well. So these things have been launched. They seem to be quite successful so far. Let's go into how to actually trade them. When you log into your Phillip Nova account, you will probably pull up a watch list like this with each of these contracts if you want to trade all of them, but you will also need to pull up the given delivery months, the given months that you want to trade, because any futures contract has a delivery date, a date by which the exchange is going to look up and say, okay, this was the 10-year yield on this date in June, and so we're going to settle whatever the value of your futures contract is. If you look all the way at the very top, you'll see the top one here is the CBOT micro 10-year yield futures for June of 2022. You'll see that it's available in pretty decent size. The bid is 2.948, the ask was 2.95. So if you think the yield is going to be, if yields are going to rise up above 2.95, you would buy this contract. If you think they're going to fall, you would sell this contract. Quite plain and simple. You could do the same with the 2-year, the 30-year, and so forth. You'll notice with the July contracts, that will show you the market's expectation of where the yield is going to be pretty much 1 month forward, if you will. And those contracts aren't quite as liquid. You'll notice the bid size and the ask size aren't quite as large. You'll notice the spread is a little bit wider, but you still can trade those, and it will give you an extra month for your view to come out. Now, if you click on any one of those contracts, so you'll notice, for example, here, I clicked on the CBOT micro 10-year futures contract for June of 2022, and I got this little menu that let me choose a few things. I could either place an order, I could look at the market depth, so I could see, for example, how many contracts were available if I was willing to go down in price to 295, 2949, 2948, so forth like that. And I can also just make sure that I'm completely clear on the contract specifications. I say any contract that you've traded for the first time, make sure you read the contract specifications, make sure you know what it is you're actually trading and what your exposure is. So in this particular case, it tells me the last trading day of the June contract is June 30th, 2022. Okay, so I've got some time for rates to move in my favor. I can see what the trading session is. It trades pretty much around the clock. And the contract size is here 1,000. That's 1,000 US dollars per point. So it means if I say buy this at 3, and then the contract goes up to 4, yield goes up to 4, I'll make $1,000. And if it goes down to 2, I will lose $1,000. That's how it works. It's not really, it's contract size per point, not notional value or like the value of a stock quite in the same way. So for anyone who's new to futures contracts, here is an example of how the 2-year yield futures would work. So let's say, for example, the 2-year yield futures currently trading at 1.5, and I'm making up this number because I've used this in different scenarios. You'll notice I still have the 2021 date on this one. But let's say, for example, you've got $1,500 in your margin account and you buy one micro 2-year at 1.5. That's $1,000 per point. Then let's say that you were right. The price settles up, and so it moves in your favor. The yield rises from 1.5 to 1.6. So technically, this is not the 2-year yield. This is actually the futures price, which is what the market thinks the 2-year yield is going to be when the contract expires. If the contract goes up and you were long, then you've made money. Philip will take $100 and then settle it into your account, and your margin balance will increase from 1,500 to 1,600. The exact opposite will happen if the price moves against you. If the price moves from 1.6 down to 1.4, then that $100 that you put in plus an extra $100, so a total of $200 will be taken out of your account, and your margin balance will be reduced down to $1,400. Trading futures is really this simple, but for anyone who is new to futures, I just highly encourage, take some time with this slide and make sure you are absolutely comfortable with how this works before you trade any futures contract. What are different types of trades you can do? Earlier I said, how would you, let's say, buy the 10-year if you thought the 10-year yield was going to go up? That's if you have an outright view. So you would trade a single contract because you have a view on the 2-year, what the Fed is going to do. You have a view on the 10-year, what you think the economy is going to do, or inflation expectations. You have a view on the 30-year because you've got a view on pension flows. The thing with any outright trade is that you have an absolute directional view. Now, what I'll remind you again, many of you may have experience doing absolute directional trades on bond futures. I will just remind you, micro yield futures are very, very different. Now, the advantage of the micro yield futures is if you want to trade a spread. Let's say you wanted to trade the 2-year versus the 10-year. Doing that with bond futures was actually a little bit tricky because you needed to match the durations of the two. You need to make sure the notional size were about the same. You get a bit of a mismatch. On the other hand, if you believe that the 2-year yield and the 10-year yield are going to converge, the curve is going to flatten, you can simply buy one 2-year contract, sell one 10-year contract, and you don't have to worry about any duration mismatch. You will be matched point for point, and I will show you a table showing you exactly what your P&L will be on that specific trade. So if you think the curve is going to flatten, in other words, the 2-year and the 10-year are going to get closer to each other, you'd buy the 2-year and sell the 10-year. If you think the curve is going to steepen, you would do the exact opposite. It is really that simple. For each of the contracts, again, refer to my previous slide to see what your P&L would be, and my next slide to see what it would be for the table. The P&L really depends on the move in the spread. So you don't need to be right about the overall direction. So in other words, if you're right about the curve flattening, even if the whole curve rises or the whole curve falls, your actual total P&L is going to be the same. So that's an advantage of the spread trade, is you don't need to have a view on the direction of all interest rates, only of the relative movement between the 2 points that you're trading. Now, the thing to be careful with is when you do a spread trade and you see how much the spreads don't move as much as the outrights, you can be very, very tempted to put on some leverage. But leverage means that even small errors can wipe you out very, very quickly. As promised, here is the table to give you an example of what would your P&L be if you bought one 2-year yield futures contract at 1.5 and sold one 10-year at 1.9. Again, you can see I made up these numbers a little while ago when the yields were lower, but if you were to do those, this table shows you how much you would make or lose depending on what the 2-year and the 10-year were at the end of the period. Now, if you buy the 2-year and sell the 10-year, you're expecting those two numbers to get closer to each other. You're expecting the curve to flatten. So not surprisingly, in the lower left-hand side of this table where the curve is flatter, you will make money. On the upper right-hand side of the table where the curve is steeper, where you have, let's say, a 2-year of 1.2 and a 10-year of 2.2, you would have lost money. Again, very, very simple table. I highly encourage you not just to study this table, but to recreate it if you are going to be trading spreads. So that was my presentation. At this time, I'd like to go ahead and hand back to Regina, see if there are any questions or any other points we should be covering.
Hi, okay. So thank you for Mr. Tariq sharing. Okay, so now we will start our Q&A section. So you can You can type your question in the question box. So later on, Mr. Tariq will answer the questions. So when you are typing the questions, I would like to share our ongoing promotion again. So basically, you can trade the micro size US indices, silver, and also US Treasury yield at very low rate and only $2.5 per lot per side. And micro products margin are usually 5 to 10 times smaller than the usual standard contracts. And it is very good opportunity if you like to diversify your portfolio or try out the US market after this webinar. So if you are interested, you can scan the QR code and register for the promotion. If you are interested to open an account, you can scan this QR code and fill out all the information at the comfort of your home. It is totally free. What you need to do is to fill out all the information, submit the documents, and deposit 1,000 ringgit to activate the account. And you can use it afterwards. If you want to receive more information from us, you can search us at Facebook, LinkedIn, YouTube, Instagram, and also Telegram. If you have more inquiries, you may contact the representative which is near to you. Okay, so now back to our Q&A section. I will pick some question to you, Mr. Tariq. Okay, so the first one is from Zakwan Abdurrahman Ahmad. The plot where countries with high rates is younger nations, right? This means that the outlook of this country economic it will expand. Is that right?
Well, in theory, yes, because if you look at when did any economy that you know of have its highest rate of economic growth, it tended to be when the population pyramid looked like a triangle, when you had enough young people to do all of the work of expanding the economy, and you didn't have a lot of old people on pensions who were not doing that much. So what I would say in general is that young demographics are necessary for high economic growth, but they're not sufficient for economic growth. I'm sure you can know examples of many, many countries that have young populations. In fact, most nations throughout human history had young populations, but they didn't have stellar economic growth because they had a lot of young people, but those young people weren't productively building the economy, they weren't increasing their productivity, and so forth like that. So bond yields can really reflect two things, or actually I would say three things. They can reflect higher inflation expectations, they can reflect higher expectations of economic growth, but they can also just reflect supply and demand to borrow or lend money. That third one is just an example where there's a lot of young people who want to borrow money for whatever reason. They either want to buy cars, they want to buy houses. Those may or may not increase economic growth. In general, the example that we often are taught of in American business schools, when there's a lot of borrowing, say, to build factories and employ those young people and increase productivity, that will tend to result in economic growth. So it's all about how that borrowed money is used that decides whether or not it will mean a much bigger economy down the road. Great question.
Yeah, okay. Thank you for the answer. Is totally agree. So for the next question, does the 30-year yield lower than 5-year yield, meaning the recession happening soon?
So the example that I gave earlier about the 2-year yield versus the 10-year yield, that is usually the indicator that many economists watch when they say a yield curve inversion predates a recession. And the usual reason for that is the 2-year really does indicate where the Fed is. It indicates where short-term money markets and other things are, whereas the 10-year is a benchmark for long-dated yields. The fives, so the 5s 30s and the 10s 30s are less watched, but in theory, they might mean the same thing. And in fact, you've seen things like that in Europe. You've seen things like that in other markets over time. What does it mean when somebody is willing to take a lower rate of return on a 30-year bond than they would on, let's say, a 5-year bond? It can mean a few different things. They may expect higher rates of inflation in the short term, but then they expect that inflation is going to taper off long term. It could mean that the buyers of 5-year bonds and 30-year bonds are just two very, very different buyers. There are lots and lots of pensions that need to buy 30-year bonds, and so they're pushing those yields low. There aren't as many buyers of 5-year bonds. It can mean a number of different things, but in general, I would agree if the 5-year is higher than the 30-year, it's not a sign of a healthy economy. It's not a sign of high future expected economic growth.
Okay. So for the next question is how would yields move in stagflation?
Well, there are different ways that they could move. So the only time that the US, so here we're talking about US yields. The only time that we really saw stagflation in that history of the chart that I showed you was in the 1970s. And there you saw yields rising dramatically, but that was partly because of what the Fed did. Um, if the Fed did not raise short-term interest rates, you might have seen long-term interest rates rise because no one would have wanted to hold bonds. Anyone who wanted to borrow for, long dated would have had to pay very, very high interest rates. Because, I guess think of what it means there. If inflation is high, are you going to be willing to accept a low rate of interest on your savings? Not if you have other alternatives, not if you have other places to go. But on the flip side, if there's stagflation, not a lot of businesses are going to want to borrow either. So another example, which is probably not great, would say be Turkey. Turkey, you could probably argue, is going through stagflation right now. What do you have? You have Erdogan firing any central bank governor who dares to raise interest rates. So what's that doing? Well, that's not doing very, very well for the Turkish lira. I haven't really been trading Turkish bonds or the Turkish yield curve, but there are plenty other examples around the world of what yield curves do when there's stagflation. In general, though, I would say the parts of the yield curve that are not controlled by central banks would tend to rise because nobody wants to earn a fixed rate of interest in a stagflationary environment.
Okay. And last question from the ground. Do you see U.S. consumer price index peak at March and going to hover around 7 to 8% towards year end?
So I don't look at this. I don't look at the CPI annual rate that much. I mean, what I showed you was kind of a bit of a spike. That was really to show you when you hear on the news 7% inflation, that's what it's talking about. To me, what matters is what is the change in CPI over, let's say, a 10-year period, or over a long period, because that's the purchasing power that that really affects us. You have X $1,000 in savings, and 10 years from now, when you go to buy your next house or buy a car, how much is it going to cost you? That's what I look at. And as I mentioned, the inflation index bond market is expecting inflation to be around 2.5% for the next 10 years. And you can trade that. Like if you believe that inflation is going to be higher, you can buy those inflation index bonds, sell Treasury futures, and you can lock in that inflation rate if you want. My own view is that the actual inflation rate is probably going to average around 3 to 3.5%, so a little bit above trend for the next 10 years. That's my opinion. And the reason is 7.5% was a spike. It was a shock. It had to do with a number of things. Basically, when a lot of money came out of the gate, it started chasing a bunch of goods and services, and it was accompanied by a rise in commodity prices. But the demographics simply are not there. There are simply way too many old people, and too much technology doing the jobs of people who otherwise would demand higher and higher wages. Those things I think are going to keep inflation in check and mean we're not going to see 7% inflation for the next 10 years. That again is my view. I could be wrong.
Okay, thank you for your answer to all the questions. Okay, so that's all for our Q&A section. Thank you, Mr. Tarek. And now is our giveaway section. I will ask 3 questions in the poll. So whoever pick all the correct answer, you will stand a chance to win 25 ringgit Shopee voucher, and only 5 lucky winners will get it. And we will contact the winners within 3 working days via email. So let's start our first question. Okay, so for first question, what are the micro yield futures contract offered by CME Group? I will give 3 more seconds to answer it. Okay, most of the people already vote. Okay, I will close the question now. So the answer for this one is actually A, 2-year, 5-year, 10-year, and 30-year. Okay, so for next question, second question is what drives the Treasury use? So you can pick one of the answer. Okay, I will give 5 more seconds. Okay, I will close the question now. So the answer for this question is all of the above. The inflation, employment, and longer-term nominal growth expectation will drive the Treasury yields. And the last question for this giveaway is what micro futures products are included in the CME USD 2.5 promotion? Okay, I will give 2 more seconds. All right, thank you for all the response. The answer is all of the above. We provide US indices, silver, and US Treasury use for this promotion. So we will contact the lucky winners. We will contact the lucky winners within 3 working days via email. Okay, so that's pretty all about for today. Thank you, Mr. Tariq, for the awesome sharing tonight and very informative sharing. And thank you everyone for joining the webinar. Have a good rest and bye-bye.
Thank you for having me. Have a good evening.
Thank you. Bye-bye.